This Silicon Valley Bank debacle has caused me to change some things in the portfolio. So even though we're still at 14% and the market's only at 0.5 and the Nasdaq's up 6%, we've lost about 100 grand within the last month. So we're at 430, now we're at 330. Now part of the reason why we're down today is because of the ex-dividend dates for most of these funds that we're in. For example, Cornerstone has its dividend today on the 14th. We made a video about that this weekend and we released it yesterday. So we're all into Cornerstone before the X date. And we also consolidated into these other funds, namely the triples. So you can see we have 6 grand of TQQ and 6 grand of UPRO, about 7 grand each. And as you see that alert, Dow futures soar 300 points as regional bank stocks rebound. See, yesterday bank stocks were down big, and that kind of delayed my reasoning into what was going to happen in the market. But today they are up big, and we knew that banks would be up big and tech would be up big if we got the bailout of SVB, because it would signal the Fed to not raise rates by as much. And now people are saying they might not even raise rates at all. So, but nonetheless, I consolidated things in the portfolio and barbelled into these triple leverage, UPRO and TQQ, and more Cornerstone. Why? Oh, and a little bit more JEPI. Okay, why? Because any bank or company that's taking their money from startup banks is now in question. Excuse me. So if you had a Roku, well, now you have to worry about their deposits. Now, they're still going to be fine because the FDIC and Fed came out and bailed out SVB, and they'll have this precedent in place for other banks as well, regional banks. But it still made me question duration risk in the portfolio with certain bonds and held to maturity assets like treasury bonds and my own bonds. It made me question whether these companies can hold till maturity as rates rise. So leverage is a factor for these companies now more than ever. I just realized, I always thought that some of these funds, they run 30% leverage. Even Cough Global yesterday, we sold that one, the Glows. They run almost 50% leverage, I heard. But so anyone who's running leverage or has long duration assets, they are going to be scrutinized closer by investors, as their balance sheets won't be worth what they were worth before. Because if they hold to maturity, they will be fine. But if they're caused to raise cash beforehand, they're going to have to take a serious hit on their books when they sell at a loss. So yesterday when I sold my securities, which is in leverage, I made sure to not sell for a loss. The only things we sold yesterday for a loss were the Glows. Excuse me, but you've been expecting the Glows to lose. I've been down on them all year. They haven't affected my performance. So whatever you see in our performance down, up 14% for the year, the Glows had zero impact on that. So I went ahead and sold that and got some tax harvesting from that. I'll get some of that money back. So that was a good thing for the Glows. We dumped some lower quality and barbelled into higher quality like Cornerstone. And I went with the triples instead of having 3K or dumping 3K each, UPRO and TQQQ, or dumping them like I said yesterday in the video and just waiting for assignment on our puts below. I wanted to go ahead and get pure market exposure that had no debt, had no leverage from loans, that is, because UPRO and TQQ are leveraged, but they don't have like loan leverage. So I wanted to get consolidate my money into things with less leverage. So like the Glows, I took them out. Some of these funds like EDF, FCO yesterday, which we told you we sold, they have some leverage. You know, I'm pretty sure about 30% leverage, but it could be more. Most of these closed-end funds run about 30% leverage. So I try to get out of the leverage aspect of them as much as possible and go into Cornerstone up top, because Cornerstone has no leverage. They do not use leverage. They do not depend on loans or certain bonds to mature in their portfolio. They only own the S&P and the NASDAQ, and they rely on investor money as they invest in shares and do rights offerings for their money. They do not rely on loans from banks. So I like that. Plus, they outperformed the S&P and Schwab over a 10-year period, as seen by on Morningstar. So we consolidated in the C's because they have the highest dividends, they bounced back the hardest, and they had the least leverage. And then we added more to the triple leverage ETFs, TQQ and UPRO. We doubled those positions because we want a full 10K each, but in each of them, because they made you $1 million, as you saw in the last video as well, how TQQ and UPRO made you $1 million. But I feel like right now is not the time to go full on 10,000 each because the market is still a little sketchy right here. As you go into, and just look at my debt real quick. So the debt's down to 211. I have 10K short though. We are hedged on SPXU, the triple leverage ETFs, TQQ and UPRO. We have 6 and 6, but we're also hedged with SQQ and SPXU 4 and 4. So we'll probably get rid of some of those at the open today as the market is moving higher. But let's go look into that. Is the market at a tradable low here? So if you go to SPY, you'll see that yesterday we had a pretty extensive move. We hit almost 380 because I believe we might have tagged it intraday, but we finished we finished at around 385. So we didn't really quite tag that 380 mark and hold it and really flush out and get oversold to the gray. But we're nonetheless finding a support area. And if you go to the VIX, you'll see that we had the double blowout. So we had we made the video on Friday and the VIX spiked to almost 30. And then yesterday it spiked past 30 and it is now overbought. So this is, again, this is the recipe for a short-term bottom, excuse me. It's very early in the morning. So we have that. Our estimated income fell yesterday because we did sell some things, and then we added to our cornerstone short. So that's going to affect our earnings. So we have about 5,000 cornerstone short. And I was going to sell yesterday and not have to worry about the X date, but the market turbulence was so high that I went ahead and decided to hold them. So 5,000 in Cornerstone, we're up 3% because today they declare the dividend. So the stock is dropping by the amount of the dividend, and I think that'll be an even higher number when the market opens. We'll see. But I could sell those for profits, but I'm thinking about keeping them on because it lowers my margin to do it. And also, it's safe protection to have against one of my largest positions. So, I mean, I have almost 400,000 in Cornerstone. Whatever we're losing to this dividend, it's peanuts compared to, what we're making on the long side. So we're still making about 96,000, even though it doesn't reflect in the estimated income because there's a negative number in there. So 5,000 here, 5,000 times 20%, that's 1,000. So take out 1,000 of my earnings, and that's what you really have. Add 1,000 back in. That's our true earnings, because that still is what qualifies to banks, are the long side. They don't see the negative dividends you have to pay when you short. So, and plus, again, I want the protection right now. We are at a tradable low, but I'm not sure if this is the final low. So, performance and value, we're still at 14%. You saw our estimated income, we're still at 96. You saw that we've consolidated our holdings into higher quality 4-star non-leveraged names that are pure index. And the only other leverage that we put on was TQQ and UPRO, but that's not leverage in the form of borrowing from a bank. This is just a ×3 leveraged vehicle. That's a different kind of leverage, just higher beta, not more debt leverage. So, and all these other names, we also sold half of everything yesterday, so that when we do have to move to sell all of them, like we said in the past video, the drawdowns and the losses will be minimal because we had 10K positions. Let's say in QYLD, we had a 10K position, or Raw, we had 15K in Raw. We sold it yesterday, most of it when we were up in it. We took profits so we wouldn't lose on leverage and have a negative decay on our net asset value. This was accretive to our net asset value, except we only have 5K in it now, to where if we have to unload from the rest of Raw as the market drops and we need to consolidate and barbell into higher quality names like TQQ, UPRO, Cornerstone, JEPI, USA, if we have to consolidate more into those, when I sell from Raw, I don't lose now as much because it's only 5,000. Before it was 15, so I would have had to lose as a bigger function of the position. But now we've wound down these positions to where when we do sell, there's about 150 grand in here of positions we can dump. All of these are 100 grand. So starting from BST down, 10, 20, 30, 40, 50, 60, 70, 80, 90, 100, 5, 10, 15, 20, 25, 30, 35, 40, 40. You can go all the way down, but it's about 150. I will dump all these holdings. I do like them. I love them, but I still have no attachment. And that would lower our margin to about 50K. If we remove the shorts, that would take our margin from 200 to about 50, because 200 minus 150 on all these assets is 50K left of debt. Then I would simply buy back 75K of the C's and these higher quality names that are higher yields, 20%. So if I sold 150 at 10% average dividends, then I buy back 75K of 20%. That allows me to lower my margin, cut it in half, cut my leverage in half, but still keep the same earnings to the banks. So this is actually, to me, a gift when you get this opportunity. Why don't I go all in the C's now and do this now? Because I want diversification away from the C's. I believe bonds are cheap. I believe that this is a blip on the radar with SVB Bank, and rates are coming down. Inflation is coming down. Today we got a good number, CPI number. Everything was in line, exactly in line. So this is what the Fed needs to either go 25 basis points or nothing at all in the next meeting. So I'm bullish on bonds. I'm bullish on tech. I'm bullish on all these various funds. I just want to make sure that I have pure objectivity here. No emotional attachment to any one sector or theme. If the market drops, I'm selling what I told you I'm selling, and I'm barbelling into the higher quality names with the higher yields at half the leverage, but same amount of income. Same amount of income. So that's what the video is going to be on today. We've repositioned accordingly. We're halfway there to fulfilling that plan that we wrote on the last video. Our strategy of when the market goes into an emergency, what do we do? We're halfway there. We're ready to sell everything else if we have to for minimal losses and pile back into the higher quality. So when the market does resume its uptrend, we'll be stronger and better for it. Thank you.